Okay, hello everyone. This is Mark Bollinger with Lawrence Berkeley National Laboratory, and I'm pleased to walk you through a new Berkeley Lab report titled Using Probability of Exceedance to Compare the Resource Risk of Renewable and Gas-Fired Generation. In a nutshell, this report develops a new probabilistic framework to account for resource risk when comparing the levelized cost of energy, or LCOE, of wind and solar power with that of gas-fired generation. Over the next half hour, I'll be touching on just the highlights of the report, and we'll try not to go too deep into the weeds, but I do just want to state the obvious right up front that the report includes a lot more detail in case anyone has a desire to dive deeper into any particular aspect of this study. So let's start by defining what I mean by resource risk. Put simply, it's the risk that the underlying energy resource that is harnessed to generate electricity will not be as plentiful as expected or will cost more than expected. Importantly, resource risk manifests differently for renewable and gas-fired generation. For renewable generators like wind or solar projects, resource risk is primarily a quantity risk, namely the risk that annual energy production will be less than expected due to a weaker than expected wind or solar resource. For gas-fired generation from a combined cycle turbine, on the other hand, resource risk is primarily a price risk, namely the risk that natural gas will cost more than expected. And as we'll see later, the significant difference in the form that resource risk takes complicates comparative analysis of its impact on LCOE. So who bears resource risk? The answer varies somewhat depending on whether the project is owned by a utility or by an independent power producer, and also whether the risk in question is high gas prices or low solar or wind output. The report walks you through this heat map in some detail to justify the various risk rankings that are shown, but I won't take the time to do that here. Instead, suffice it to say that resource risk falls disproportionately on ratepayers or retail electricity customers more broadly, and that in general, higher than expected gas prices appear to be riskier to ratepayers than lower than expected wind and solar output. And all of this simply means that it is incumbent upon utilities, regulators, and policymakers to make sure that resource risk, and in particular natural gas price risk, is factored into the decision-making process whenever new generation resources are being contemplated. Now, some utilities have been pretty good about this, specifically factoring in and calling out wind and solar's diversity benefits or long-term hedge value as one justification for procurement. And the top half of this slide contains some quotes to this effect from both investor-owned and public utilities. But in other cases, utilities have not been moving quite fast enough to satisfy some of their largest customers, and as a result, we've recently seen a wave of corporations procuring wind and solar power on their own. And again, as you can see in the bottom half of this slide, these corporate procurements are often driven by wind and solar's long-term hedge value. But what is this hedge value worth, and how would you even go about trying to quantify it? These questions have been studied pretty extensively in the past using a variety of methods, which include mean variance portfolio theory and risk-adjusted discount rates, diversity indices, decision analysis and certainty equivalence, scenario and sensitivity analysis in conjunction with Monte Carlo simulations, and finally market-based assessments of the avoided cost of hedging gas price risk using conventional hedging instruments. Although each of these approaches brings something interesting and useful to the table, for a variety of reasons that I won't get into here, none of these approaches are entirely satisfactory on their own. And there's a text box on page 2 of the report that goes into this in a little more detail. So this brings me to this new framework that's developed in this report, which focuses on comparing worse than expected outcomes using probability of exceedance. Just to quickly introduce probability of exceedance, it's a tool that has long been used in the wind and solar industries to describe the uncertainty surrounding projections of annual energy production at a given project site. And those uncertainties in energy production are, of course, closely tied to uncertainty surrounding the quality of the underlying wind or solar resource. The median annual energy production estimate is called the P50 estimate, which means that there is a 50% probability that actual energy production will exceed the P50 estimate. And of course, in this case, this also means that there's a 50% chance that actual energy production will fall below the P50 estimate. Resource analysts will also typically estimate annual energy production at a number of other common P levels besides P50, and these typically include P75, P90, P95, and P99, with P99 being pretty much the worst case estimate in the sense that there's a 99% chance that actual production will exceed the P99 estimate. The P99 production estimate will, of course, always be below the P50 estimate, but the gap between the two does narrow over longer time horizons, given that some of the random uncertainty tends to cancel out over time. And for this reason, analysts will often calculate the standard suite of p-values over several different time horizons, at a minimum over 1 year and 10 years. And different parties involved with a project will actually be interested in seeing different p levels or p-values calculated over different time horizons. So for example, a developer who's negotiating a PPA price may be most interested in the P50 value, which doesn't vary over time, while a tax equity investor in a wind project may be more interested in looking at the standard suite of p-values over a 10-year term, given the 10-year window of the production tax credit, or PTC. Meanwhile, a lender concerned about a potential default will perhaps be most interested in the 1-year P99 estimate, and likewise, ratepayers who are unsure about their future plans may have a similarly short-term outlook. So even though resource decisions are often made with a long-term horizon in mind, it is still important to consider these shorter time horizons as well, because they are important to a variety of stakeholders. So as I've already mentioned, probability of exceedance is really based on or determined by the uncertainty surrounding annual energy production. And that uncertainty has three main elements: measurement error and interannual variability of the underlying resource, and then also modeling error when converting the measured resource into a production estimate. To combine these errors, you need to add them in quadrature, as shown here in equation 1. While measurement and modeling error are both considered to be systematic in nature, interannual variability is instead considered to be random and normally distributed about the mean, which means that it, and hence total uncertainty as well, tends to decay or cancel out over longer time horizons. And this table provides the breakdown of uncertainty estimates that I'll be using for the LCOE modeling a little bit later on. For solar, I've chosen values that are roughly in the middle of indicative ranges provided by Black & Veatch and AWS True Power, which are two consultancies that do a lot of resource studies. For wind, meanwhile, I'm using values from an actual wind project that's operating in Oklahoma. And again, those values from that actual project fall within a range provided by AWS. The bottom few rows of the table show the resulting total uncertainty estimates derived from equation 1 over 3 different time horizons: 1 year, 10 years, and 25 years. Not surprisingly, total uncertainty diminishes over longer time horizons, and you can also see that wind's uncertainty is a little larger than solar's. The final step is to plug the total uncertainty estimates into equation 2, shown here, in order to derive all other p levels of interest. Now, although equation 2 implies a symmetrical distribution around the P50 estimate, when focusing on annual energy production, it's actually not quite symmetrical, given some technological constraints at the very upper end of the resource distribution. For example, if your wind project is already operating at full capacity because of strong winds, then you're not going to get any more incremental production out of a further increase in wind speed. So that leveling off at the upper tail complicates things a little but fortunately, in this paper, I'm focusing on worse than expected outcomes rather than better than expected outcomes, and the lower end of the resource distribution is not similarly constrained in this way. So here are the resulting P50 through P99 distributions of wind and solar capacity factors over various time horizons ranging from 1 to 25 years. And these are the capacity factors that will be used in the wind and solar LCOE calculations later. As you can see, the P50 capacity factors do not vary with time horizon, but all other P levels do drift upwards and gravitate towards the P50 estimate over longer time horizons. And again, this is due to a canceling out of the interannual variability. In other words, resource risk starts out wider over shorter time horizons and narrows over longer time horizons. So that's the process for wind and solar, but what's the corollary for natural gas prices? Well, here we can take some inspiration from the Energy Information Administration's Short-Term Energy Outlook publication, which each month calculates and presents confidence intervals around natural gas futures prices. These confidence intervals are derived by running the famous Black-Scholes option pricing model backwards in order to derive the level of volatility implied by the option price. And that so-called implied volatility is then plugged into the confidence interval equation shown in the upper right of this slide, and the result is a set of confidence intervals that look like those shown in the graph in the upper left. As you can see, these confidence intervals start out narrow around the central gas price projection, but then widen over time. And those of you who have been paying attention will no doubt recognize that this is the exact opposite of what we just saw for wind and solar capacity factors, whose distributions start out wider but narrow over longer time horizons. And this key difference between renewable and gas-fired generation is really at the heart of this new framework to compare renewable and gas-fired resource risk. Now, the EIA only calculates these confidence intervals going out a few years at most, and this is because their use of implied volatility requires a liquid options market, which just doesn't exist out beyond a few years. Because I want to extend these confidence intervals out further for as long as 25 years, I need to therefore rely on historical rather than implied volatility. And so here we see the daily price history of natural gas futures contracts going back to 1990, along with a rolling 7-year estimate of 1-year price volatility. As you can see, there are 3 distinct pricing periods characterized by different levels of volatility. Presumably the most recent period, characterized by relatively low and stable prices resulting from abundant shale gas supply, is the most relevant of these 3 pricing environments going forward. So that's what I'll go with. In other words, I will be assuming that the current empirical volatility estimate of 32.3% calculated over the post-2008 period will hold going forward. But we're not quite done yet. Just as wind and solar resource uncertainty declines over longer time horizons due to mean reversion in the interannual resource variability, so too does gas price volatility decline over longer time horizons due to an element of mean reversion. Now, because we're focusing just on the gas price history since 2008, we can't actually empirically measure gas price volatility over periods of longer than 7 years, when what we really need are 25 years. Fortunately, there is a commonly accepted way to extrapolate single-year volatility over longer periods simply by dividing the 1-year volatility by the square root of the number of years in question. And so that's what I've done, and that's what is shown by the dashed green line in the bottom graph. As you can see, the extrapolated volatility curve pretty closely approximates both the empirical historical volatility estimates from years 1 through 7, as well as the implied volatility curve shown during the first year, 2017. And finally, that brings us to the resulting probabilistic gas price projections shown on this slide. The central or P50 price projection shown in green is made up of the natural gas futures strip over the first 13 years, followed by an extrapolation at the same slope for the remaining 12 years. The red lines show the P1, P25, P75, and P99 gas price projections. And again, this range of price projections starts out rather narrow but widens with time, which is the opposite of what happens to the range of wind and solar capacity factors that I showed earlier. The bottom graph on this slide levelizes the price curves from the top graph over the relevant number of years. So for example, at year 9, the bottom graph simply levelizes the first 9 years of prices from the top graph over a 9-year period. While at year 16, the bottom graph levelizes the first 16 years of prices from the top graph over a 16-year period, and so on. And it is these levelized prices that are shown in the bottom graph that will be fed into the LCOE calculations. And let's actually turn to LCOE now. Here you see the various modeling assumptions that go into the LCOE calculation for a wind, solar, and combined cycle plant, all of which commenced operations at the start of 2017. All of these inputs, except for the 3 that are shaded in green, are held constant across all modeling runs. But the 3 green shaded inputs, namely the wind and solar capacity factors and the levelized gas price, will vary by both time horizon and by P level. And here we see the first set of results comparing the 25-year LCOE of a wind project with the PTC to that of a combined cycle gas turbine. Now I need to explain a few things here to hopefully avoid some confusion down the line. First, as noted in the text box on the right, the worst case or P1 wind LCOE actually results from a worst case or P99 wind capacity factor. But given the terminology of probability of exceedance, which of course refers to the probability of exceeding something, I need to call the worst case LCOE for wind a P1 rather than a P99. I know that's perhaps a little confusing, but it's also a relatively minor point. What's a little more important, but is also perhaps a little confusing, is how to think about time horizons along the x-axis. As explained in the text below the graph, all of the data points on the graph show 25-year LCOEs. So in other words, the x-axis does not impact the 25-year term over which LCOE is always calculated. Instead, the x-axis simply shows the time horizon in number of years for the 2 uncertain inputs, which in this case are the wind capacity factor and the levelized gas price. So for example, at year 12 along the x-axis, 12-year wind capacity factors and 12-year levelized gas prices at different P levels are plugged into the 25-year LCOE calculation. Hopefully that all makes sense. If not, maybe pause the video, think about it a little, perhaps rewind if needed, or even check out the report, which hopefully is a little more clear. In any case, what you can see here is that with the benefit of the production tax credit, or PTC, wind's worst case LCOE is below the combined cycle plant's best case LCOE over all time horizons exceeding 2 years. And this is perhaps a major driver of the wave of corporate procurement that I mentioned earlier. In other words, this recognition that there is a very low probability of wind being out of the money going forward may be enticing some corporations to jump in now. If you get rid of the PTC, the LCOE of wind and gas is more comparable. On this slide, I'm just focusing on worse than expected outcomes for both wind and gas, and also highlighting the standard suite of common p-values with their own curves. And what you see here is that wind without the PTC is more expensive than gas on a P50 basis for all time horizons of less than 24 years, which is where the 2 P50 curves converge. But on a P25 basis, wind costs less than gas over all time horizons longer than 16 years, which is where those two P25 curves cross. This break-even point drops to 10 years, 8 years, and just 2 years for the P10, P5, and P1 levels, respectively. In other words, this is a pretty good example where gas is expected to be a bit cheaper than wind on a P50 basis over most time horizons. But once you start to look at worse than expected outcomes, then wind starts to look better, and in some cases a lot better. Here's a similar comparison, but in this case showing wind with the PTC against just the operating costs of the gas-fired generator. And this particular comparison is intended to reflect today's reality, where you've got new wind projects still benefiting from the PTC, but for the most part they are competing against existing gas-fired generators that are bidding into power markets at their marginal operating costs. And you can see that at every P level, wind is cheaper than gas-fired OPEX over every time horizon. And as noted on the graph, there are also multiple instances of lower probability wind being cheaper than higher probability gas. Here we see a solar comparison. So this is a utility scale PV project with the benefit of the 30% investment tax credit, or ITC, and it's being compared to the LCOE of a combined cycle gas generator. In this case, solar is always more expensive than gas on a P50 basis, regardless of the time horizon shown. But if you move away from P50 and consider the possibility of worse than expected outcomes, then solar offers some significant hedge value. Now you might have noticed in the previous graphs something that I'll refer to as hedge wedges, which start where the various P-level curves cross and then widen over longer time horizons. But here I've specifically highlighted those wedges by removing all of the other clutter from the graph. I think of these hedge wedges as a useful representation of hedge value, where, not surprisingly, the lower the P level, the shorter the time horizon over which hedge value begins to accrue, and the greater the amount of hedge value that exists over the full 25-year time horizon. Finally, although there is good reason to vary the time horizon along the x-axis and to consider shorter time horizons, as I've done in the previous graphs, for the most part, resource decisions are made with a fairly long-term time horizon in mind. So with that in mind, and in an attempt to consolidate results from all four comparisons that I've made onto a single graph, here is a bar chart showing the cost difference between gas and renewable generation over the full 25-year time horizon. No real surprises here, given what you've already seen on the previous slides. Likewise, this table of numerical results will hold few surprises, but I've included it to demonstrate that the results are not just graphical in nature. There are real numbers behind them. And I also want to note that even though all of the previous graphs have been comparing results at either the same P level or across different P levels, we should keep in mind that this framework is probabilistic in nature, which provides an opportunity to probability weight the results across a range of outcomes. And that's what's shown in the bottom two rows of the table. For example, if you compare the top and bottom rows of the table, you can see that on a straight P50 basis over a 20-year time horizon, wind without the PTC is $0.8 per megawatt hour more expensive than gas. But when you probability weight across the full P50 to P1 range of outcomes, as shown in the bottom row, wind is actually $0.8 per megawatt hour cheaper than gas. Okay, just to wrap up, this new framework has a number of advantages relative to many of the other approaches that have previously been used to analyze this issue. First, unlike most other approaches, it recognizes that wind and solar also face resource risk, though of course in terms of quantity, not price, and it thereby presents a fair comparison to gas price risk. It's also familiar in the sense that probability of exceedance is already widely employed by energy analysts and policymakers alike. It's relatively simple, requiring just a few accessible modeling inputs for each type of resource, and it's flexible, catering to any level of risk aversion over any time horizon. I at least have found it to be fairly intuitive, particularly once I've wrapped my head around and kind of gotten beyond the basic statistical concepts. And finally, its probabilistic nature enables probability weighting of a range of outcomes. Of course, the rather narrow focus on LCOE neglects a lot of other things, and it's important to recognize that few, if any, resource decisions are made on the basis of LCOE alone. Instead, the cost of competing resources really should be considered along with the value that each provides, which is typically determined by an involved modeling process that goes well beyond the rather simple framework developed here. And with that thought, I just wanted to leave you with a very recent example of one such modeling process that ended up highlighting the long-term hedge value of wind power. So earlier this month, Southwestern Public Service filed for regulatory approval to procure more than 1 gigawatt of new wind power by 2019. The filings reveal that SPS is procuring this wind solely as a cost-saving measure, that is, to displace higher-cost resources that it already has. Furthermore, based on production cost and capacity expansion modeling, SPS determined that this new wind power will displace 22 billion cubic feet of natural gas each year, which represents roughly 20% of SPS's annual gas burn for power generation. And it will do so at an equivalent gas price of just $2.40 per million BTU. This locked-in equivalent gas price of $2.40 is well below the base case gas price forecast of $4.90 and is even well below the low gas price forecast of $3.76 per million BTU. And you can see in the graph in the bottom left that there's an expanding range of potential gas prices over longer time horizons, as well as the flat wind equivalent gas price, all of which are perhaps somewhat reminiscent of the hedge wedges that I showed you earlier. And I thought I'd just end with that since it's a nice example and a recent one as well. So thank you for listening. If you're interested in learning more, or if I happen to lose you somewhere along the way, feel free to download the report, which is freely available at the website shown here, or you can rewatch this video as well as many other Berkeley Lab research presentations on our YouTube page shown at the link here as well. Finally, as always, please feel free to shoot me an email if you have any questions or comments. So thank you, everyone, and have a great day.
Thank you. Please stand by.